Welcome to the Peak Wealth Podcast. My name is John Perry, Senior Wealth Advisor with Steel Peak Wealth. I thought for our first real episode of the podcast, we would tackle a simple but important topic, and that's in wealth management investing. That's going to be the differences between ETFs and mutual funds. Now, mutual funds have been around a long time. Most investors are familiar with them. When I started in the business, it was the main vehicle that we used outside of individual stocks and bonds. But probably for the last 20 to 25 years, the ETF or exchange traded fund has become a bigger and bigger part of wealth management, and I utilize them quite a bit myself in my own practice. And I actually find that there are a lot of advantages to using ETFs rather than mutual funds. And I think it's important that investors know what differentiates them. So we're going to take a few minutes and we're going to talk about those main differences. And I'm going to have a little chart put up on the screen for everybody. And really what this chart shows is between active mutual funds, which means that the holdings within them can be changed like any portfolio, index managed funds, and just like the title sounds, these are mutual funds that are static portfolios that track an index like the S&P or the NASDAQ. Then you have ETFs. And just to show a comparison here, let's just say the last column is stocks. And if you look at this real quick, you can see that everything but the stock is diversified. Stocks and ETFs trade actively on an exchange. You have intraday pricing with ETFs and stocks. And what that means specifically is when you're buying or selling them throughout the day, the price is moving and you have that opportunity to buy or sell them within the trading day. There are management fees in mutual funds and ETFs, whereas individual stocks, obviously, there is not. And if you're in an ETF or a fund that tracks an index, obviously the goal there is to perform the same or as closely as possible to that underlying index like the S&P. Now, there are some other differences that I think are important to lay out, and I have another chart that we'll take a look at here, which this one might be a little harder to see, but I'll run through it real quick. How are ETFs managed versus mutual funds? And again, you can have a passive ETF or a passive mutual fund or an active ETF, active mutual fund. And really, just like the description sounds like, either it's a static portfolio if it's passive, like SPY is an ETF that tracks the S&P index. And there are also mutual funds that just track the S&P or other indices. And how are they traded? I mentioned this briefly in the chart before, but ETFs trade throughout the day very similarly to a stock. Okay, it's supply and demand. All right, the more people purchasing a particular ETF, that's going to affect the price of the stock, or selling an ETF, just like a stock. What's the minimum investment? Well, for an ETF, just like a stock, you're going to purchase shares or units of that ETF. So the minimum amount is going to be whatever that price is. So if it's $20, one share is going to be $20, just like a stock. For mutual funds, they only price at the end of the day, okay? And that's the net asset value of the underlying portfolio. So both ETFs and mutual funds are a basket of stocks or a basket of bonds, depending on whether you're buying equity, ETFs or mutual funds, or fixed income. But unlike ETFs, as you can see by this chart, mutual funds can also be purchased in fractional amounts, which means that if you're going to get a dividend, you can reinvest it, and whatever that amount of money can buy, you can potentially buy a fractional amount of shares of a mutual fund. And what are the costs? Both ETFs and mutual funds have internal management costs. Okay, those are their expense ratios, and that's important to know because typically ETF have a lower price structure than mutual funds, and mutual funds also have an additional cost, typically called the 12B1 fee, which is for marketing, and ETFs do not have that. Another important aspect that we don't go into on this chart is the taxation. Mutual funds pay short and long-term gains, and at the end of the year, that gets distributed to the investor based on how many shares of a mutual fund they own. Most mutual funds do not pay capital gains, short or long-term, out to the client. I always found that confused clients. It affects the price of a mutual fund when they pay out those gains. I find that there's a lot more transparency with ETFs when it comes to the management of it and also the taxation of it, which again is a very, very important aspect. I find it's more advantageous for the investor. In my own practice, I use a lot of ETFs. I subscribe to what my father and I used to call a core and satellite type of strategy. And what does that mean? Kind of think about it like a planet with some moons around it, okay? Just to give an illustration and paint a picture. If I want to invest in a particular area like S&P high quality stocks, I might buy an ETF that has that strategy. And now I've got in one shot a diversified basket of high quality S&P stocks. But maybe I want to pinpoint a couple of stocks that I really like or my client likes. And again, I'm not going to give recommendations on particular stocks on my podcasts, but just to name common stocks that everybody knows in the S&P, you have Apple, you have Google, you have Netflix. So if somebody wants to have that kind of specific exposure, or a wealth advisor wants to add that to add a little potential enhancement to the portfolio, that's how I like to do it myself. So we'll have a core strategy where we own maybe 2, 3, 4 ETFs, and then we might surround that core strategy with satellites in the form of individual stocks that I think are going to add some oomph to the portfolio. So really, in a nutshell, I think you can kind of get the gist that I'm a big fan of ETFs. Occasionally, I may use a mutual fund, but very infrequently. And I think this is a way for most investors to add instant diversification without adding too much risk that you will get holding individual stocks. If, say, you're only holding 5, 6, 7 individual stocks, if something happens to one of those stocks where they sell off a lot, it's going to disrupt the performance of the entire portfolio. This way, we're diversified using 3, 4, 5 ETFs, maybe more depending on the size of the portfolio. And then in addition to that, adding exposure to individual names that, say, I really like, or maybe the client has an interest in. So that's really it. That's my little ETF 101 investing. And stay tuned for more podcast episodes where we talk about specific wealth management and stock market ideas. And don't forget to follow us on Spotify, Apple, YouTube. And if you miss any of our episodes, they'll be posted there. We'll see you soon. Have a great day.